The Individual Investor Show.
You want it all, don't you? You share one thing, they all need money. Now let's see if they're brave enough to earn it.
Hello, and welcome to the Individual Investor Show. My name is Jenna Brashear, your host for this evening. Thanks again for tuning in. I hope you all had a wonderful week. According to a 2021 study by the Morgan Stanley Institute for Sustainable Investing, 79% of individual investors and 99% of millennials in the United States are interested in sustainable investing. However, it's important to understand what sustainable investing entails and how companies are graded, especially when it comes to avoiding corporate greenwashing. Tonight's event is the Individual Investor Show, the ESG Playbook for the Socially Conscious. So for this episode, Charles Rotblut and Anine Sus chat with Larry Swedroe about the challenges individual investors may face when investing in ESG securities, in their article in the May 2022 issue of the AAII Journal. Swedroe also highlights a few key factors from his new book, Your Essential Guide to Sustainable Investing, which highlights how ESG ratings are impacting both individual investors and corporations. In the second part of tonight's broadcast, we asked Matt Bajkowski about his latest article in the May 2022 issue of the AAII Journal, The Difference Between Sustainable Investing and Impact Investing, which looks at investing with a focus on financial returns versus investing with a focus on social or ethical-based outcomes. But before we jump in, I do want to preface tonight's presentation by reminding our viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. So, without further ado, sit back, relax, and enjoy our presentation.
But Larry, thanks for joining us.
So socially responsible investing started off tied to religious values. How do you think SRI maintains its origin in a more secular world?
Well, first of all, SRI, I think, has started out, as you noted, as religious-based. The Quakers, for example, wouldn't buy companies related to guns. Then you got evolved over time into tobacco and alcohol, and then South African boycotts was the thing in its day. But it's evolved to a much broader categories, especially with the concerns over climate change and also corporate governance. And so it's widened to an ESG and even now broader term called sustainability. And then you even have another category we talk about in our book, Your Essential Guide to Sustainable Investing, which is impact investing, where people care not so much. The prime motivation is not the return on investment, but having an impact on people and the planet. So SRI, ESG, people still, I want to express my values, but I want to meet my financial goals at the same time. And maybe I don't want to make any sacrifices there. And there are ways to do it by tilting the portfolio to factors that have higher expected returns like value, profitability, and quality, and size as well. But impact investing is more like, I want to fund a water well in Botswana so people could have clean water, and we're going to fund that, and they'll be able to, generate income from that project. But that if it doesn't get a good rate of return, I don't care so much about it. I'm really much more concerned about having an impact. And there are companies that focus on impact investing. In many cases, it's a global effort. In others, it's more doing work in your own community. And so everyone's going to have their own vision about what's important to them. I think the most important thing now is people have a wide variety of ways to look at this issue, and they can choose the one that is most appropriate for them.
And that was another question, and it's probably the paradox of SRI. When you look at cannabis companies, like for instance, Canopy Growth broadly talks about its environmental credentials. And then also their social and governance as well. How do they fit into an SRI strategy? Because from a sin point, cannabis definitely falls on the spectrum.
Well, you hit on the central problem of this whole issue that we've been discussing. There are no right answers, and it's really your own personal expression of values, right? So, I don't, and then by the way, just because you're a cannabis company doesn't mean you're good at the S and have diversity and treat women fairly and minorities and pay gaps. Doesn't mean you have good governance. You have investor friendly rules and stuff like that, right? You could be bad on those things and maybe be environmentally friendly.
And what about, I guess, in terms of U.S. corporations, what impact is sustainable investing having on not just, obviously BlackRock's Larry Fink, but all this money moving into ESG and SRI type investments?
Yeah, as we discuss in the book, we have a whole chapter dedicated to the question of are ESG, sustainable SRI investors impacting corporate behaviors in a favorable way. And all of the research is consistent right across the board, showing that because companies who have bad scores end up with lower PEs, and that means a higher cost of equity capital, they pay higher interest costs on their debt. They have a harder time attracting employees. Their employee satisfaction is not as high, which means their employees they do get are less productive. And so companies are reacting very favorably to keep or gain a competitive advantage by having a higher ESG score. That means investment companies will allocate more capital to them. Their cost of capital goes down. That gives them more ability to make investments in cleaner energy and new technologies. And that creates this virtuous circle. And the evidence is very clear on across the board. It's having an impact on how they're treating employees and how they're even branding to try to create better images and being more aware of the impact it does have on their cost of capital.
Great.
Yeah, and one positive of sustainable investing seems to be a reduction in risk at the company level. Could you explain why?
Yeah, clearly companies that have good E-scores are less subject to having, environmental risk problems that create massive losses like Exxon Valdez, for example. You have less risk of oil spills. You have a good governance. There's less risk of fraud. If you have, bad S, you're likely to get a lot of bad publicity, and then you can have consumer boycotts of your products. All right. And so companies are really becoming very conscious of this. And the research does show that companies with poor ESG scores do have more tail risk. They're more subject to these big surprising shocks that can happen. And we just had a test of that with COVID, and the green companies did actually perform better. But the research going back further than that shows that they tend to have better risk controls, and therefore there's less tail risk, and investors hate tail risk. They don't like risk in general, but when that left tail risk shows up and the stocks get hammered, that's what they want to avoid. And you're willing to pay a price to avoid that risk and accept lower returns. That's a good trade-off. By the way, that's why stocks in general have had such high returns over the last century, because boy, they certainly have tail risk. And we saw a 60% drop in 2008 and 35% drop with COVID and almost 90% drop in the Great Depression. That's tail risk. When we know investors hate tail risk, and that's why they, in general, are not willing to pay very high PEs to own stocks, except when we get bubbles. Then they forget history and get too enthusiastic.
And then I guess on the investing side, when I did a search on our site, it looked like about 60% of the ETFs labeled by Morningstar as being sustainable investments have been in existence for 3 years or less. Any suggestions for how an investor might go about choosing an ETF, given so many have limited histories?
Yeah, well, first of all, let me say that Wall Street is great at creating demand for product where there shouldn't be any. So things like SPACs and thematic ETFs. The history of the industry, but even before there were ETFs, but with ETFs now, you get all these new themes popping up. And what the research shows is they all have some common characteristics. They're very high beta stocks, and the worst performing stocks, the evidence shows, over the long term are stocks with high betas. Their average beta is 1.2. So they're 20% more risky, and they are less profitable. They have negative loadings on the profitability factor, and more profitable companies have outperformed less profitable companies. So generally, they're bad investments. And yet, as soon as they get created, cash is flowing in, because Wall Street is creating products probably by looking at Twitter and other things to see what people are interested, and then they roll out these products. What I would be most concerned about is not necessarily how long the fund is in existence, but how long the management team has been in existence and what is their discipline. So if Dimensional Fund Advisors comes out with a new product, I'd have no problem investing with it immediately, because they have a 40 or more year history of extremely disciplined investing based purely on the academic research. If a company like Vanguard came out with a product, I would feel similarly about that. On the other hand, if you got, Kathy Woods coming out with something, I'd run as fast as I could.
And I guess just to relate to this question on investing, I guess this is more philosophical, but if an investor wants to do good with their wealth, obviously at one end of the spectrum is maximize your returns as much as possible and then use it. And then obviously the other end is incorporating SRI fully into your portfolio strategy. For investors trying to choose between these, extremes, any suggestion on how they can go about it?
Well, one strategy, as you point out, is to say, and let's just assume we're now in this new equilibrium and you're not going to see any preference overall. So, meaning if ESG's got 80% of the investments, that number is not going up. So cash flows in, so it doesn't change valuations, right? So one thing to say, okay, boy, now all this has happened, I can get a big premium by investing in those brown or sin stocks. Maybe let's call it, it's 3% a year. So I'm to pick a number, let's say you had $1 million portfolio, 3% a year is 30 grand, right? I'm gonna take that 30 grand and invest it directly, not invest it, but make a charitable contribution to the causes I am most passionate about, and I can make a direct impact doing it that way. That's a perfectly rational strategy. I would have no problem with that at all. On the other hand, somebody's on the other extreme and says, I really care. I don't want to invest and support any companies that aren't doing everything right in this ESG. So I'm going to, invest in that way, and I'll create my own portfolio. But even those people can say, through a separate account manager, I'm going to only invest with companies that meet my criteria, but then I'm going to tilt the portfolio in the same way Dimensional Fund Advisors does, and other fund families like Avantis and others, so it looks like a smaller cap value, high profitability fund. And those stocks that have those characteristics have outperformed over the long term by several percent, let's say the same 3%. So in that case, you could have your cake and eat it too. But now you don't look like anything like the market, right? And when you go through periods like 96 through 99 and 17 through 19 or 20, then you're going to way underperform the market. But you shouldn't care. You made a decision. I want to express my values. I'm in it for the long term. And over the long term, you get those higher expected returns. but you have to be willing to ignore the benchmark of the market. But you said, I don't want the market because I don't want to be in energy stocks or sin stocks or others, and they're in the market. So why should you care? But people do, sadly. So one thing I do tell people is this: it is far more important to choose a strategy that you will stick to than to choose a strategy with the highest expected return. Because if you won't stick to it, the risk will always show up, and then you will panic and sell because you're not committed to it. You don't have the faith and confidence. And every risk strategy I know goes through long periods of underperformance. So people, for example, look at what I call the black winter for value stocks, which was 17 through 20, was the biggest drawdown in history for value, worse than the dot-com bubble by quite a bit. And then they say, well, why do I want to, the year is different? No, nothing's different. The same thing happened exactly, basically, in 98 and in other periods where we had bubbles in growth stocks, and then they burst and things go back to normal, okay? It's just that you don't have the patience and discipline. So I point out, this fact. If you invested in the S&P 500, there are 3 periods of at least 13 years where they underperformed totally riskless treasury bills. 17 years is the longest, from 66 to 82. 13 years was recent, 2000 through 12, and 15 years from 29 to 43. So the very same people who say, Larry, look how badly value did. It did so poorly in that period that now even if you go back 15 years, it underperformed. Are the same people who ignore the fact that the S&P underperformed for far longer periods. And that's against T-bills. The value stocks did well, in terms of outright returns, just dramatically underperformed the glamour stocks. Now that still is underperformance, but if you're willing to stick with it, today value stocks are as cheap almost as they've ever been, even though they've dramatically outperformed since around October of 2020 by quite a bit. If you just look at valuations today, you should expect that value stocks are going to outperform by more than their historical average because they're way below their historical price gap between. And by the way, the same thing is true about emerging markets and international, which underperformed the last decade, but outperformed from 2000 to 10, outperformed in the 70s and 80s, but everyone forgets they're subject to this recency bias. So I do want to emphasize, whatever strategy you're going to do and adapt, make sure it's one that you will stick to because that fits your belief system and you're willing to live with it and ignore what I call the noise of the market.
Good advice. Thanks, Larry. Anine, anything else that we didn't cover?
No, that was great. Thank you so much. You gave us so much.
It's my pleasure. So hopefully, for those who are interested, we wrote this book, Your Essential Guide to Sustainable Investing, because we felt there was no book out there at all that did anything more than tell you about the history of the SRI ESG movement. But there was no book that showed you what the academic evidence has to say and economic theory has to say about the risks and rewards of investing in ESG, how ESG investors are impacting companies and the planet and employees in positive ways, and actually how to implement the strategy. So we're real pleased, and we're of course very pleased to have Burton Malkiel write a great foreword for the book, and we've already heard from college professors that they intend to use this book in their classes to teach ESG investing. And my last comment is, one of the nice things about reading any of my books is I'm always happy to answer any questions from readers. I put my email address there and I answer everyone. So that's another benefit of reading the book.
That's great. No, it's a great book. I really enjoyed it. But you always write great books.
I appreciate it. What I need you now to do is go on Amazon and write a review.
Okay.
Anyone else who reads the book, do that, and use your social media to spread the word. And I think if the more people read the book, I think we will get more people investing sustainably in a more intelligent way as well. They'll be more informed. And I think we've showed them the way that they can actually get better returns while living their values at the same time.
Annette, thanks so much for making time to chat with me today about the article in the May AAII Journal, The Difference Between Sustainable Investing and Impact Investing.
Hey, Jenna, thanks for having me.
Yeah, thanks so much for joining. And I just wanted to jump right in and ask you my first question about your article. So in your article, you begin with the topic of socially responsible investing, also referred to as SRI. Can you give us a little bit of background on what that means and how this movement first started?
Yeah. So when we're looking at sustainable investing as like a big topic, there's smaller subcategories, and socially responsible investing is one of those. From an investor standpoint, it's still a process of looking to maximize your returns at a given level of risk. But the main difference is that you're being socially responsible. So it's some type of ethics or morals that are coming from your social, your culture, and that's impacting what you choose to invest in. So particularly, a good historical example that I read about had to do with the Quakers, and in it was the 18th century. They put out a sort of like a fact sheet, right, about businesses to avoid investing in, investments to avoid that were profiting off of, at that time, slave labor. So what that example shows is that socially responsible investing, its main purpose is to take the entire universe of available investments, but then kind of carve out little sectors or industries or companies that don't fit your ethical or moral values. So mainly it just has to do with segmenting parts of the market that you don't want to invest in. But from there on out, you're still looking to do the same things that any other investor is looking to do. So it's just specifically saying no to certain types of investments.
Really interesting. I didn't know that, for a lot of people, SRI or, socially responsible investing is quite new, but I didn't realize that the roots are actually dated back, over 100 years ago or more.
Yeah. And I think when you think about any type of personal choice or customization you put into your investing, I think even you could probably say like Islamic finance laws kind of fall under this socially responsible investing, right? It's creating a set of rules that apply before you make the investments based on your day-to-day culture.
Makes sense. And I wanted, on the other side of things, a lot of people have heard about or have heard the term ESG. So I just wanted to kind of go into that and ask you, what is ESG? And then also, how are companies striving to adopt ratings or anything to do with ESG factors?
Yeah, so where socially responsible investing is more so about a process where we're looking first at sectors and industries that you don't want to invest in, and then moving forward. ESG in its present state is more about developing a separate rating system. The equivalent, say, of a ratio such as like the price to earnings ratio or the dividend yield. So ESG is looking at factors of E is environmental. So that would be perhaps carbon data if a company has that. The S factor is social. That has to do with particular how they treat their employees, their customers, and their suppliers. And then the G is governance. So it's how the board is operating with its shareholders. So the difference for ESG and developing a rating system is that you're not looking to first eliminate parts of the market or the way you are with socially responsible investing. What you're looking to do is take a grade, much the way AAII stock grades can be used. And that way you can relativize a company's performance based on these factors. I think certain companies are more so striving to adopt these ratings and factors. But I think the pressure will come when there is more regulatory oversight, which I do think is coming. But what constitutes ESG is more so an alternative rating system, or an additional, is probably a better way to put it, rating system.
And when it comes to these ratings, is there a leader in ESG investing, and why is this the case as they're classified as like a leader?
Yeah, I'd say really BlackRock is probably the leader in ESG investing. And I think primarily it has to do with their role as one of the largest fund managers and advisors. Between them and Vanguard, you're most likely invested in one of the two somewhere. I think BlackRock does a lot of business on the private side and portfolio customization. And like I mentioned, that's kind of the basis almost of socially responsible investing, is this customization. So I think they see a lot of, granted that this is ESG and sustainable investing are kind of having if they kind of existed before on the fringes or implied in businesses, it's very explicit now. And there seems to be an explicit market that's coming for it. I think BlackRock wants to be, or has decided to be, that leader. Basically be the market maker for it if they can. And so I think from their private side, they probably already have systems and processes in place to customize these portfolios for their investors that want to put ESG focus on. And then I think from the standpoint of creating the market or creating a new business segment, BlackRock has the reach to do that. And I think they've just kind of decided to make the business sense to be that leader. As far as access to data too, being such a large company, they're able to pivot off that size and probably get better quality data across a wide amount of companies and industries, and then actually take the power to implement that into their portfolio selection options.
And if AAI members are looking for ESG screens or other resources, can they find those things on our website? Yeah, they can. Specifically for members, you can find out whether a fund or an ETF has an ESG focus on their individual evaluator pages. So if you type either the name of a fund or its ticker into the search box at the top of the AAII website, that'll take you to its individual evaluator page, which it'll say there. Also, members all have access to our annual fund and ETF guide. And that itself also has a socially responsible column that you can sort all the funds that are in the guide on. If you're an A+ investor subscriber, you also additionally have access to our ETF and mutual fund screeners. Those are using the same data that the guides are using. So that's coming from Morningstar. So it also has access to that same socially responsible category that Morningstar produces. So the difference there is in the screener, you can screen specifically based on that. So yeah, if you're an A+ investor subscriber,
you could utilize a specific screen to do that.
That's excellent to hear that we have some, great resources for members to get invested and start, learning about ESG or, socially responsible investing if they are interested. So that's excellent. And then I did want to, in the second portion of your article, you delve into impact investing. So I wanted to ask you if you could give us some background on this type of investment style and how it differs from socially responsible, SRI, or ESG ratings.
Yeah, so where ESG is a kind of a rating that applies to everything, socially responsible investing is kind of a customization of your investment portfolio. Impact investing is it's closer to charity and philanthropy than the other two, ESG and SRI. Here we're talking more about the emphasis on, say, forming a nonprofit that tackles one specific issue. But with impact investing, lately, the turn has moved into even having for-profit companies. The idea being that if you can create a for-profit business that is making a difference in sustainable ways. So, you could be choosing any type of ESG focus, right? You might want the business to focus on environmental concerns. You might have a social concern, or maybe you have a governance concern. And in some cases, impact investing is about being an active shareholder. So that does apply. But very specifically, this is about kind of forming a business that can, when it's a for-profit business, it's something that can maintain itself over time and be both a profitable investment for shareholders, but also make a long-term difference. The idea being that when you're just looking at, say, a fund or something more passive, it's harder to ascertain or feel that impact of what your investment is doing on an ESG basis. So that it's more so about making a very specific kind of institutional investment and impact.
And I wanted to ask you about the limitations that that individual investors may face in regards to finding impact investments and actually investing in this sector.
Yeah, so because impact investing tends to fall more towards the philanthropic side of investing, for most individual investors, the vast majority, it's going to be very, very hard to invest in. Most of impact investing is going to take place in the private equity sphere, which means it's really going to be available to institutions, foundations, or high net worth individuals that meet the accredited investor standards. So the tough part with equity investments in private companies is that the shares are unlisted, so it's not regulated to the same extent. There's little public information available, and also there's this idea of your money being locked in. So it's pretty typical for these investments, since it's not publicly traded, it's not liquid. So when you're making a private equity investment, it's kind of under the idea that your money is going to be locked down for at least 5, if not kind of 10 years is kind of what could be expected. So individual investors really benefit from liquidity. So the fact that this is mostly happening in the private non-liquid market makes it pretty hard for individuals to get into.
That's really good to know. And, I wanted to ask you, after doing a lot of research for this article and going into all the different aspects of SRI and impact investing and ESG ratings, what is your own take or perspective on SRI and ESG investing? And what did you learn from, your research, and what do you think is going to be in the next, couple of years? Like, what can we expect?
Yeah, well, I hard to tell the future, right? But my hope is that much in the same way that, say, like 100 years ago, right? The federal government brought in, Kennedy Sr. To I think be the first chair of the SEC. And basically they brought him in because they needed regulation. There wasn't enough ongoing at that time. We had issues with the stock market leading up to the Great Depression. And there was a realization that more needed to be done. I think the market will continue to demand more certainty and less uncertainty when it comes to ESG ratings. I think that ESG as a grade will continue to be probably the norm in terms of how we think about these things being applied to investments going forward. The kind of debate, I think, philosophically for ESG is, isn't business already sustainable? Shouldn't a business already want to perpetuate itself? And I think the answer is yes, of course. But the issue, no matter what, is there are always going to be blind spots in our thinking and seeing. And I think what ESG is trying to do is shine some light on some of those blind spots, some of those inefficiencies that businesses have. I think, granted, the market will punish you no matter what if your business is being too inefficient. But I think there's something to be gained from a broader knowledge of how much more efficient companies can be. And a lot of them won't be held to that if they're not challenged or graded in some way. I think so that's where ESG will really continue to push. As far as socially responsible investing, I think that's going to continue to be important as a source of portfolio customization. But from there, that's more so dependent on the consumer or the individual investor themselves, right? How deeply do you want to be involved with your portfolio? Some people are gonna very much so want to be involved with that customization process. But I'm guessing the majority of investors will be passive. So I think socially responsible investing is never going to go away. But I think where the future is going to lie is in the more concretization, if that makes sense, of ESG as a grade.
I tend to agree with you. I see that a lot of people, really interested and invested in, learning about ESG ratings and hoping that they, bring more regulation, like you said, and also, have a little bit more transparency than they do now. So I definitely see it growing as a sector, but maybe, people, making critiques, to make it better as a whole. So I tend to agree. Well, excellent. Thank you so much for chatting with me, Matt. I really appreciate it.
Thanks, Jenna.
And I just want to remind viewers that they can access the latest journal issue and all the articles within by visiting AAII.com/journal. And thanks again for delving into your article with me today. And I really appreciate it. And now for a message from our friends at Discover Bank. We know as individuals interested in building investor wealth, you never want your money to be idle. Even small dollar amounts for short amounts of time should be working for you. With that, we're pleased to share information from our partner Discover Bank on deposit accounts that keep your money moving. You can choose from several options to help you meet your short-term or long-term financial goals. The best part? All of the deposit accounts offer preferred member rates. Take a look. With Discover, you can earn over 5 times more interest than the national savings average with preferred member rates and pay no fees. That's no fees, period. Plus, no minimum balance is required. You can access your AAII member savings account with Discover Bank from your smartphone or tablet, so it's easy to keep your money moving in the right direction. Open an AAII online savings account to start saving for the future today. Visit aaii.discoverbank.com to learn more. Did you know through Discover Bank, AAII members have the opportunity to save with high-yield CDs, savings and money market accounts, and as well as IRA CDs? Also, AAII members receive preferred member rates on all Discover Bank products. You can visit aaii.com/savings products to learn more and open an account today. We hope you enjoyed tonight's broadcast. I want to thank Charles Rotblut, Anine Sus, Larry Swedroe, and Matt Bajkowski for making time to discuss these important topics with us. I think a good takeaway from tonight's interviews is that both ESG and SRI investments can be beneficial for your overall portfolio. However, you should always do your own research before investing in either of these sectors. And as always, please remember to click the subscribe button if you'd like to be alerted of future II shows. You can always catch a replay of tonight's event by visiting our YouTube channel, and make sure to register for upcoming AAII events and webinars by visiting aaii.com/webinars. And if you're an investor on the go and want to catch the II show while driving or going for your daily walk, you can now follow us on all your favorite podcast platforms such as Spotify, Apple Podcasts, Amazon Music, and more. Also, members can read both articles in the AAII Journal, plus so much more, by visiting aaii.com/journal. And with that, we wish all of you viewing good health, good fortune, and a great evening. Thank you and happy investing.